Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Yesterday afternoon, the Reserve Bank Board left the official cash rate on hold at 4.1%. It's a pause, we know that, but it may not be the end of rate hikes. We're not so sure about that. Stephen Halmarick is the Commonwealth Bank Chief Economist. Stephen, welcome back to Fear and Greed.
Thank you, Sean. Very good to join you again.
You expected them to pause yesterday, Stephen.
Yes, we did. So it was pleasing to see the pause, not just for the fact that we called that one correctly, but also I think for lots of Australians facing the pressure of higher interest rates, whether they've got mortgages or renting. I think the pause yesterday would be welcome news.
Okay, so why did they pause?
Well, our reading of the statement from the Reserve Bank really has highlighted three reasons. The first was, well, they've done a lot already. So they note that, interest rates are up 400 basis points since May last year. That's a lot of tightening. They wanted a bit of time to assess the ongoing impact of those higher rates. Secondly, they pointed towards the May Consumer Price Index indicator, which did show a decline in the annual rate of inflation, by that measure at least, down to 5.6% from high sixes previously. So they said that it showed a further decline, which was good to see. And then thirdly, they just reinforced the idea that by pausing yesterday gives them a little bit more time to assess the impact of previous rate hikes, particularly the move in May and June. More information coming towards the end of this month, particularly on inflation. So just give them a little bit of extra time to decide the next move forward.
So the wait and see part of your answer there, I mean, 20 years ago, I suppose, when I was following economics more closely, working for the Financial Review, people like Ian Macfarlane were always talking about we're going to wait and see what the numbers tell us. Phil Lowe, as a governor, has been, well, I'm not quite sure whether he's in the Ian Macfarlane category of waiting and seeing or not, but it does seem that it's possible that we might not get further rate rises if they wait and see and the numbers come in lower than they expected, particularly inflation, or is that not likely?
Well, as you say, this has been a very unusual tightening cycle in the fact that there's been a lot of tightenings in a row. They've missed a couple of months. Of course, they missed a month earlier this year, April, and now they've missed July. But the unusual thing about this tightening cycle is just really how rapid it's been, and month after month after month. As you say, going back to governors like Ian Macfarlane, and well, I'm actually old enough to remember Bernie Fraser, and even earlier than that. But I think it's fair for them to point to, well, we've done a lot of tightening. There's a lot of information coming up in the next few weeks. Let's wait to reassess that. So, the critical data point is towards the end of this month, we get the June quarter CPI. Now, it's great that we're getting the CPI indicators now, but they're not the full picture. So getting the June quarter CPI towards the end of this month is going to be a really important piece of information. Of course, we also get another round of monthly retail sales, employment numbers. And then at early August, the Reserve Bank will do its normal quarterly reassessment of all their forecasts. So they'll get the CPI numbers, they can reassess all their forecasts. And that's why you quite often find, particularly in previous cycles, interest rate changes, either up or down, in those quarters where they have their statement of monetary policy, including August. So we'll get one more at this August meeting.
Okay, so the June quarter CPI is kind of the most critical piece of data, Stephen?
Yes, I think, yes, it is. The retail sales and the employment numbers and a few other data points will be important as well, but the quarterly CPI, I think that's the main number that the RBA and ourselves and the market will be focusing on between now and the August board meeting. So if that shows inflation is continuing to trend down, consistent with the Reserve Bank's forecast, they'll be very pleased to see that, and I think that means we're getting towards the end of the rate hike cycle. But our base case forecast is one more in August.
Stay with me, Stephen. We'll be back in a minute. I'm speaking to Commonwealth Bank Chief Economist Stephen Halmarick. The Reserve Bank talks about the painful squeeze that some households are experiencing at the moment, and they clearly are keeping an eye on consumption and household spending. What do you think the prognosis for that is? Because, I mean, I'm sure the Commonwealth Bank, better than any other organisation in the country, understands mortgages. You must be seeing some of that pain coming through.
Well, yeah, so we do have the benefit of being able to get a really great feel and snapshot on the economy using the internally generated data. Particularly, we can look at things like spending on Commonwealth Bank credit and debit cards.
Mm-hmm.
Now, that's slowing. There's still some slowing to go. We think that the consumer spending will be quite soft over the next 6 to 12 months. Essentially, the way to think about it, or the way I think about it, is people's real income is going backwards, as in, wage rises are less than the rate of inflation. And certainly after you take account of higher interest rates, people being pushed up to higher tax brackets, real household disposable income is declining. And if people are having to spend more of their income on either servicing their mortgage or paying their rent, it just means less income to spend on everything else. And that's why we think consumer spending will continue to soften in the year ahead. And that's what the Reserve Bank, that's what they're wanting to see to help bring demand and supply in the economy back more into balance.
What about inflationary expectations? Can you explain to listeners why they matter so much and why Phil Lowe is definitely worried about expectations?
Yeah, for sure. So they highlighted that again today. So inflation expectations is really about, if you think inflation's going to stay, let's say, around that 7% level, you will adjust your behaviour for that expectation. So you will probably demand a higher wage. So you might want to spend now, you might want to buy things now on the view that, well, in the future, you think they're going to be more expensive. So those inflation expectations can get embedded in what people call a wage price spiral. So you're spending more money now, you're demanding higher wage now because you think inflation is going to be higher in the future, and that higher spending, that higher demand for wages then helps cause that higher inflation that you're worried about. So it definitely wants to get inflation expectations lower and anchored around the target range. So generally people say, well, I know inflation's a bit high now, but over the next year or two, it's probably going to come back down again. Therefore, I don't need to adjust my behaviour too much for those higher inflation rates.
And you mentioned wages. Again, the Reserve Bank yesterday talked about wages, and we've had the Fair Work Commission decision about 6 weeks ago or so. How worried should we be about wage increases, excessive wage increases?
Well, I think the secret there, Sean, is what do you mean by excessive, right? So, so we've got a tight labour market. The unemployment rate's 3.6%, so almost a 50-year low. So it should come as no surprise that wages growth has been accelerating. And of course, we look at the things like the national wage case, extra income going to the lowest paid people in Australia in a very tight labour market. That makes a lot of sense. And we can see also, particularly in the public sector, some demands for a bit of catch-up after wage caps during the COVID period. But the Reserve Bank Governor makes the point, in which we would agree with, that you can't have wages growth running well above the rate of productivity growth for an extended period. The outcome would be higher inflation. So you want wages growth to be within the target range of inflation plus whatever productivity growth is. So if inflation expected to average 2 to 3%, whatever productivity growth is on top of that, that's what wages growth can be. And the Governor has talked about or pointed to levels around 3.5% to 4%. So that would assume around about 1% productivity growth. Inflation 2.5 to 3, productivity growth 1, gives you 3.5 to 4 on wages growth. So over the medium term, wages growth above that is really not consistent with the inflation target.
Okay, Stephen Halmarick, Chief Economist at the Commonwealth Bank. I can't let you go without asking you about house prices. And of course, the Reserve Bank yesterday did mention house prices. Where do you think they're going?
Well, yeah, so house prices up another 1.1% across the country in the month of June. So it's the fourth month in a row that they've been rising. I should say dwelling prices, so housing plus apartments. So that's a pretty unusual cycle where dwelling prices have started to rise well before the RBA finishes rates. But I think, for all your listeners who have done economics, it's really just the laws of supply and demand. So demand for housing is rising, particularly because of the big increase in net migration this year, 400,000 net migrants expected, as opposed to the pre-COVID levels that were about 230,000 every year. And despite a big increase in building approvals last month, the number of new dwellings being built or approved and to be built is actually softening. So we're just not building enough new dwellings for the increase in population, so prices are rising. So we expect dwelling prices to be up about 3% in calendar 23 and up another 5% next year, after being down 10% peak to trough in this cycle earlier on.
Stephen, thank you for talking to Fear and Greed.
My pleasure. Thank you.
That was Stephen Halmarick, Commonwealth Bank Chief Economist. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.